Most investors think choosing a broker is no big deal, but after testing Vanguard, Fidelity, and Schwab with real money, the difference shocked me. One gave me 5x the cash yield, one locked up my money, and one nearly cost me thousands in hidden fees. This could quietly make or break your retirement. The broker you choose will either quietly grow your wealth or silently bleed it dry. And the crazy part? Most investors never even look at the things that matter most. So in this breakdown, I'm covering exactly what separates winners from wallet drainers: platform technology and user experience across desktop and mobile, cash management setups that can earn or cost you thousands, real customer service when it counts, not just a chatbot, the account types you didn't even know you might need, like HSAs and trusts, investment access, index funds, ETFs, and hidden fee traps, automated investing that works for you, or quietly drains performance. And finally, my definitive ranking for beginners, pros, and passive investors alike. Most people think all brokerages are the same now, same free trades, same funds. But after breaking down how they actually make money, the truth shocked me. What started as a race to zero commission fees has evolved into a comprehensive battle for your entire financial relationship. Fidelity Investments, Charles Schwab, and Vanguard Group represent three distinct philosophies in wealth management, each with over $7 trillion in combined assets under management. Fidelity, founded in 1946, has positioned itself as the technology leader, investing heavily in digital platforms and customer experience. Their approach combines traditional full-service brokerage capabilities with cutting-edge fintech innovations. Schwab, established in 1971 as a pioneer in discount brokerage, has built its reputation on comprehensive financial planning and cash management solutions. Meanwhile, Vanguard, created in 1975, remains the champion of low-cost index investing, with their unique mutual ownership structure ensuring investor interests align with company priorities. The landscape shifted dramatically when Schwab eliminated trading commissions in 2019, forcing competitors to follow suit. This move fundamentally changed how brokerages generate revenue, pushing them toward asset-based fees, payment for order flow, and cash sweep programs. Today's competition centers on digital experience, comprehensive financial services, and investment research quality rather than basic trading costs. Here's what nobody tells you. Vanguard's platform looks like it was built in 2005. Fidelity's, it feels like you're trading inside a fintech startup. Let me show you what I mean. After extensive testing across desktop platforms, mobile apps, and tablet interfaces, Fidelity emerges as the clear technology leader. Their Active Trader Pro platform offers institutional quality research tools while maintaining intuitive navigation for casual investors. Fidelity's mobile app consistently ranks highest in user satisfaction surveys, with seamless account switching capabilities crucial for investors managing multiple retirement accounts, taxable accounts, and HSA accounts. The platform's asset allocation tools and portfolio analysis features integrate smoothly across all devices, providing real-time synchronization that many competitors struggle to match. Schwab's street-smart platforms offer robust functionality but suffer from interface complexity that can overwhelm new investors. However, their thinkorswim integration following the TD Ameritrade acquisition provides advanced options trading capabilities unmatched by competitors. The learning curve remains steep, making it less suitable for beginner investors focused on long-term investing strategies. Vanguard's digital experience continues lagging significantly behind competitors. Their personal advisor services clients receive enhanced web interfaces, but traditional self-directed investors face outdated designs and limited functionality. This two-tier approach creates frustration among index fund enthusiasts who built Vanguard's success but receive inferior digital tools. Navigation between account types remains cumbersome, particularly problematic for investors managing traditional IRAs, Roth IRAs, and taxable brokerage accounts simultaneously. Cash management capabilities reveal crucial differences that directly impact investor returns. Fidelity provides superior sweep account yields through their federal money market fund, currently offering approximately 5% annual yield on uninvested cash balances. This advantage compounds significantly for investors maintaining substantial cash positions during market volatility or while building emergency funds. Schwab's FDIC sweep program appears attractive with federal deposit insurance, but delivers disappointing 0.45% yields that essentially penalize investors for holding cash. This forces constant vigilance to transfer funds into higher-yielding money market funds or treasury bills, creating unnecessary friction in portfolio management. The yield differential between Fidelity and Schwab. Sweep accounts can cost investors hundreds or thousands annually on significant cash balances. Banking integration further distinguishes these platforms. Both Fidelity and Schwab offer checking accounts, debit cards, and credit cards with competitive rewards programs. Fidelity's Visa credit card provides 2% cash back on all purchases, while Schwab's American Express relationship offers valuable travel benefits for frequent travelers. These integrated financial services appeal to investors seeking consolidated wealth management rather than managing multiple financial relationships. Vanguard essentially abandoned cash management services, forcing clients to maintain separate banking relationships. This philosophical choice aligns with their low-cost index fund focus, but creates inconvenience for investors preferring integrated financial services. Customer service quality becomes critical during market downturns, tax season, or when managing complex estate planning needs. Fidelity and Schwab maintain substantial advantages over Vanguard in service accessibility and expertise. Both offer dedicated representatives for higher balance accounts, branch office access, and 24/7 phone support during market hours. Fidelity's customer service consistently receives high ratings for response times and representative knowledge, particularly valuable when handling required minimum distributions, tax loss harvesting, or retirement planning questions. Their online chat functionality provides quick answers for routine inquiries, while phone support escalates to specialists for complex issues. Schwab's service model emphasizes comprehensive financial planning with assigned representatives for larger accounts. Their branch network provides face-to-face consultations for investors preferring personal interaction. Investment research quality rivals major investment banks, offering detailed equity analysis and market commentary that supports informed decision-making. Vanguard's service limitations create significant frustrations for investors with complex needs. Hold times frequently exceed 30 minutes, and representative training appears inconsistent regarding advanced portfolio strategies or tax-efficient investing techniques. Their low-cost structure necessitates minimal service investment, but this creates problems when investors need guidance beyond basic index fund selection. All three offer the same index funds, right? Not quite. The sneaky difference is in how much you actually keep and which platforms quietly take a cut. However, subtle differences impact long-term investors focused on index fund investing and asset allocation strategies. Fidelity provides the broadest mutual fund selection without transaction fees, including access to Vanguard ETFs alongside their proprietary zero-fee index funds. Their FZ-ROX and FXNAX funds offer total stock market exposure with zero expense ratios, though these funds don't pay securities lending income to shareholders that traditional index funds typically distribute. Schwab's ETF lineup includes competitive expense ratios across broad market indices and sector-specific investments. Their Schwab Intelligent Portfolios Robo advisor requires higher cash allocations than optimal, reducing long-term returns compared to fully invested portfolios. However, their research platform provides excellent fundamental analysis tools for investors conducting due diligence on individual securities. Vanguard remains the index fund pioneer with the longest track records and most tax-efficient fund structures. Their mutual fund to ETF conversion capability provides tax advantages unavailable elsewhere. However, purchasing non-Vanguard mutual funds incurs transaction fees that can erode returns for dollar-cost averaging strategies across multiple fund families. Account variety becomes crucial for investors with complex financial situations involving business accounts, trust accounts, or health savings accounts. Fidelity offers the most comprehensive HSA platform with zero fees, full investment options, and no minimum cash requirements. This advantage appeals to high-deductible health plan participants, maximizing tax-advantage savings for healthcare expenses and retirement planning. Trust account management represents another Fidelity strength, with sophisticated estate planning tools and fiduciary services that support wealth transfer strategies. Their institutional platform rivals dedicated trust companies while maintaining discount brokerage cost structures. Schwab provides excellent business account options including solo 401k plans for self-employed individuals and small business owners. Their corporate services division handles employee benefit plans and institutional investing with professional-grade platforms and service teams. Vanguard's account options remain limited, particularly problematic for investors with small business needs or complex family office requirements. Their institutional services focus primarily on large retirement plans rather than individual wealth management needs. You've heard about Robo advisors, but here's what matters. How much of your cash sits doing nothing? One of these platforms traps up to 28% of your money in low-yield cash, without telling you. However, investors preferring consolidated account management may find value in these integrated solutions. Fidelity Go offers automated portfolio management starting at zero fees for accounts under $10,000, with 0.35% annual fees for larger balances. Their goal-based investing approach incorporates tax loss harvesting and automatic rebalancing, while maintaining access to human advisors for complex questions. Schwab Intelligent Portfolios requires $5,000 minimum investments and maintains 6 to 28% cash allocations that drag long-term performance. While the service itself carries no advisory fees, the opportunity cost of excessive cash holdings effectively creates hidden charges that exceed competing platforms. Vanguard Digital Advisor provides basic portfolio management, but lacks the sophistication of dedicated robo-advisor platforms. Their 0.20% annual fee appears competitive but doesn't include tax optimization features standard among specialized providers. Selecting the wrong brokerage platform creates switching costs that discourage optimal portfolio management. Account transfer fees, tax implications, and service disruptions can significantly impact investment returns during transition periods. Platform stability represents another consideration, particularly during market volatility when access becomes critical. Fidelity and Schwab maintain robust technology infrastructure with minimal downtime, while Vanguard has experienced service interruptions during high-volume trading periods. Regulatory changes could impact payment for order flow arrangements that subsidize commission-free trading. SEC proposals might force brokerages to charge explicit trading fees again, potentially altering competitive dynamics across these platforms. The optimal brokerage selection depends entirely on your specific investing needs and account complexity. Beginning investors focused on index fund investing and retirement savings will find Fidelity provides the best combination of technology, service, and account options. Their zero-fee index funds and superior cash management create measurable return advantages over time. Active traders and options investors benefit from Schwab's comprehensive trading platforms and research tools, particularly following their TD Ameritrade integration. However, the cash sweep disadvantage requires constant attention to optimize yield on uninvested balances. Index fund purists committed to Vanguard's investment philosophy should consider using Vanguard ETFs through Fidelity or Schwab platforms rather than enduring Vanguard's service limitations. This approach captures Vanguard's low-cost index funds while accessing superior technology and customer service. Want more of this in-depth analysis? Your likes and subscriptions guide what topics I cover next. Hit that like button if you found value in this comprehensive breakdown. After analyzing platform technology, cash management, customer service, investment options, and specialized accounts, Fidelity emerges as the clear winner for most investors. Their superior digital experience, competitive yields on cash balances, excellent customer service, and comprehensive account types including HSA options create compelling advantages. Schwab represents a solid second choice, particularly for investors prioritizing comprehensive financial planning and advanced trading tools. However, their poor sweep account yields require constant management that many investors prefer avoiding. Vanguard should be considered only by investors exclusively focused on index fund investing who rarely need customer service and accept limited digital tools. For most investors, accessing Vanguard products through superior platforms makes more sense than enduring Vanguard's service limitations. The brokerage landscape continues evolving rapidly, but Fidelity's technology leadership and comprehensive service offerings position them well for long-term success.